All right. Hello, everybody. We are back again for our second webinar on our short-term rental taxes. This one's specific to short-term rental, basically taxes 101. So I say this is the baseline of all things accounting in the US. So thanks for everyone for joining us. I'm from St. Louis, so I saw there was a St. Louis in the chat. So welcome from probably near me, but um, pop up our normal disclaimer before we go ahead and get started. And then, of course, I'll introduce myself per usual. And then there's our disclaimer, the general gist of what we have. And then if you want to move forward, Petra. All right. So there I am again, Brandon. I am our accountant in residence here at Hospitable. I've actually been here for a year today, so that's very exciting that this webinar came just in time. But today we're going to be really talking about all things short-term rental, specifically with tax, all things income, expense, just kind of get you in line and why everything kind of aligns. So we will continue on. So this, like I said, I mentioned, this is a three-part series. So we had the first one last week where it was just kind of a roadmap of all things and questions that anyone had with our friends at Keystone. And then today, like I said, short-term rental. And then our next one, which will be in 2 weeks' time, will be staying compliant all year with Hospitable, and a lot more breaking down of what property management does and what we offer Hospitable that helps with accounting and all of those kind of pieces. I did want to mention that what is actually going to come from that after is a new monthly office hour with me. It'll just be a 30-minute, basically a Q&A. I do a lot of office hours. I know a lot of people try to meet with me. It's a little bit trickier. So what we decided to do was once a month, I will just do a 30-minute ask me anything within reason that I can answer, of course, with knowledge base and give you as much information that I can help you with and get your accounting and your questions answered the best I can. And then I do want to mention, like I said, I am Brandon, the accountant residence at Hospitable, but I am not necessarily telling you how to do your accounting. I'm just giving you all of the details and best practices of things of how to do and what to do whenever you are setting up your short-term rental. So today, just kind of highlight, we're going to talk through, income reporting and the different things with categories, the rev rec side of things. We'll also do the same thing with expense reporting and a little bit more detail on repairs, improvements, and those types of expenses. We'll talk definitely about depreciation, and I always want to make sure that we talk about passive and active income if some users haven't been on or not, and kind of talk through the short-term rental tax loophole that we've talked about, and then just of course best practices and a lot of the common mistakes we see, and then of course the Q&A. Yes, I did see if you do have questions, I definitely put them in the Q&A, the chat, and I'll have Petra on the back end and she'll be putting them in the Q&A and we'll be answering those at the end, and then some of them actually may be getting answered throughout. So definitely for sure keep putting questions in if you have any, but this, like I said, is going to be very high level and kind of talk through all the different things with income and reporting. So with that, I think we're ready. So starting out, we're going to start talking about income reporting specifically. So next slide, Petra. There you go. All right. So basically, when you think of like income and income reporting, specifically short-term rental, there's so many different pieces with it and where that aligns. So income basically is everything the guest pays for the use of the property. So even if it's like an OTA, like Airbnb or VBO, they always deduct their fee first, but you still report the gross amount before the fees. And I'll talk about that next a little bit more in detail. So some of the things that we talk about with income categories, you definitely look at, you'll see there's accommodations minus discounts. You have reservations fees such as, cleaning, pet, linen, management, extra guest fee, resort, community, other. Upsells are a big one that we've recently seen a lot more now, especially with a lot of our users using Hospitable for their upsells, such as early check-in, late checkout, and then extra, purchases that we've seen, such as gift baskets or heating the pool, damage payouts. So think of this like on Airbnb. If for some reason something was damaged, you may receive a payout for that, which becomes miscellaneous income to you. Cancellations, in some places cancellations are considered as income, and so you'll be counting that as well. Pass-through taxes, which are reported to the IRS, they do count that as income. We look at security deposits. As long as they're not refunded, they are considered income. And then I also mentioned for the property management side of things, we have property management commission and then fees and ad hoc charges that may exist there. I do like to mention a few specific things. Like I said, discounts are taken into account before and not actually included in income. So I know that sometimes gets a little confusing, because income is going to be from what you're entitled to get. And when you think about a discount, you aren't really charging that on that. So it's not what you could have gotten; it's what you actually did charge for. So for example, not offering that 10% discount's not included in that. So you always minus the discounts before reporting the income. And then security deposits, like I said, they're generally not going to be considered income if they're refunded. But if you did receive a secure deposit and then did not refund it for whatever reason, then it does become income at that point. All right. So reporting gross versus net income. I know this comes up a lot, and a lot of times it comes up during 1099s, and I understand why. So the IRS guidance requires that income is always reported on a gross basis rather than net. So when and if you did receive a 1099 this year, it is reported that exact way. All the income's reported to you, and then you expense the host service fees after the fact, generally on your tax return. And honestly, this is one of the biggest mistakes I've seen in accounting for short-term rentals is that hosts will simply just report the payout as income and accidentally report their accounting inaccurately because of that. So if we're looking at this example I have on here, just kind of high level, we have an accommodations, which is just the nightly rate minus discounts is 300, cleaning fees 100, you charge a $50 management fee in the booking, but there's also a host service fee of $70. Realistically, your gross earnings is 450, and that's reported to the IRS that way. And then your actual net earnings are 380. So that's, of course, right there. You're taking out that host service fee. So when you think about it this way, host service fee is generally a piece that's missed, and it's a bit confusing. And I like to kind of break down the reason why in the best way of thinking about it this way. So with the host service fee, you have a platform like Airbnb or VRBO. They're managing the booking process and the flow for you for the guests that book. Since they're a business like everyone else, they're going to charge some type of fee or some type of commission for their assistance. But since they're handling the payment processing and sending the payout to you, they're just going to go ahead and take that fee during the process because it's super simple. Why not? They could definitely invoice you for the fee. And we've seen that booking.com sometimes does this, that they'll pay you out and then ask you to pay them back the fee. But such a big hassle to be able to actually do that when they can just take that fee in real time. And so that's what's super nice is that they are basically just saying, hey, we're going to take it out so you don't have to invoice us. Sorry, we don't invoice you, you pay it. But you're really actually entitled to that $450, and then you're just paying $70 as a, hey, thanks for your help. It's a expense to me. So that's why it's reported that way. So what you would do is you basically would say, I report 450 as my income on my tax return. You report a $70 host service fee expense, and then you net 380. And so what's kind of interesting there is you're basically getting the same number. So if you put 450 and then expense $70, your income on your tax return is going to be 380. That's what it's net to. If you just put 380, you're getting the same number. You're not getting charged any difference in tax. It's just according to the IRS, you're actually underreporting your income, underreporting your expense, which underreports your accounting. But ultimately, you get the same number. So I always just kind of like to mention that's kind of a common piece that you miss is reporting gross versus net, and that's the reason why. So kind of high level there, and that helps provide a little bit more insight. So always report all the income, always report the expense. You get the same answer at the end of the day, and that's kind of what that works from a reporting gross versus net standpoint. All right. So then I wanted to kind of talk through the two types of accounting that you'll see generally. And since they're super important to make sure that you kind of understand how it works and why things are reported a certain way to kind of understand the accounting back end. So accrual basis accounting is kind of built on the idea that you're accruing income and expenses. So accrual basis. So let's think of income. So income, it's actually recorded when you earn. So if you did something, that's when you actually are going to record that income. Same idea with expenses. You actually are going to record it when it's incurred. So when it's actually something that, was needed to be done. And so that's where it's a little bit more complex. So with accrual, you're actually using more balance sheet accounts like accounts receivable, accounts payable. I'm sure you've heard those before. Um, and so it just becomes a little bit more tricky there. So if you think about it this way, let's say you had a booking in January that was paid to you in December. You actually record the cash, but you actually aren't really recording the income yet because the person didn't check in. You didn't really do anything for them yet. They didn't get to use the property. That's what the idea of the accrual piece would be, is saying, hey, I got paid early. I don't record it as income yet. It just sits on my books. And then I will go ahead and say, okay, it is now income once they've checked in and the bookings actually occurred. So cash basis is the opposite side of that, where it's all based on the flow of funds and cash. So when you're looking at income, it's always recorded whenever it's received and actually paid to you. And the exact same idea with the expenses. So it's recorded whenever you're actually paying it. Honestly, very, very common, and it's way simpler. And the nice thing with this is it actually aligns with the IRS and tax reporting, which is super, super nice from that perspective, because cash basis means that you can actually set up your accounting to be able to just print it out at the end of the year and do your taxes, which is nice and also super helpful for your CPA or accountant if you use one. So just kind of looking at it a little bit this way is it's kind of the same idea before, is you got paid for a booking in December, but the guest was in January. We've seen this sometimes happen on Airbnb, where someone you get paid for a December booking, and let's say it comes out, whatever, and the booking finalizes in January, and it gets a little confusing on where it ties. Well, it was processed in December, so then you technically would count it as income whenever it was processed to you. I do mention, because I know there may be a stickler out there that knows, the IRS does require that some companies do accrual basis accounting. It's not required for most companies because you're really small. It's companies that either they maintain some form of inventory, or they make $30 million in gross receipts in a given year. And if you're making 30 million on short-term rental, that is amazing. So I'm definitely pleased. That's great to hear if you are, but generally most people just use cash accounting because you're well under that amount. And so that's generally the reasoning why. All right, so we're going to go ahead and move over to the expense side of things now. So expenses, of course, another big major area that impact businesses, and there's going to be a huge variety of expenses. So I've highlighted some of the most common ones you're going to see, but generally these expenses are just ordinary and necessary to keep the business running. And then because it is necessary, they basically fall as deductible. That allows you to write them off on your tax return. So I know there's going to be way more than these. I just created the most common ones we generally would see, from that perspective. And you can break them out even more. So advertising, you may have like photography, you may have like a website fees, all of that. Commissions, which host service fees would fall under, cleaning, maintenance, repairs, utilities. So think of any of your electric, gas. Internet typically is usually separate, but some people put it under utilities. It kind of depends on where it falls. Supplies, think of cleaning supplies, house supplies, anything you would need to kind of get the house ready. Insurance, which could be property insurance, it could be umbrella insurance, it could be anything that's specifically tied to the business. Taxes, property taxes, sales taxes, taxes you pay your payroll, all of those. Mortgage interest, if you own. If you rent and you do arbitrage, you can write off the rent payment. Continuing ed, so for example, like if I go to a conference, and I would go for a short-term rental conference, those are deductible as continuing education. And then business travel, if you're traveling for business purposes and what needed. And then refunds and reimbursements. I generally like to add this because what's a little tricky with the refunds and reimbursements is, let's say someone stays at your Airbnb, they're there for 2 nights, you refund them the cleaning fee because let's say something wasn't clean well. Let's say that's the case. You are, let's say, already paid out that reservation and it's already been processed to you. Well, that refund and reimbursement is going to come out of a future pay, generally, or future payout. So what you'll record this as is you'll record it as a actual expense to you on your tax return, because you have to report everything as gross. So with refunds and reimbursements are already sent out and they're taken out of that actual booking and they're sent before the payment's been processed, think of it that way, then it's nothing you have to worry about because it's already been considered. So if someone's like books your house for 2 weeks from now and they decide next week that, hey, you know what, I'm actually going to take off a night and it doesn't affect any cancellation, nothing, then they get refunded that amount and then you're totally fine. There's nothing there. It's not recorded as income until then. So that's kind of what I like to mention on there. and kind of how all of those actually do. If you are interested, we do have our help articles where they have a robust list of income and expense accounts that we created for an owner type, rental type, and property management type. So we have those in our help articles that we're more than happy to share to kind of give you guys information if you need that as well too. All right, so this is kind of a very well-known area, but a lot of questions always come from it because it leads to how depreciation and other things work that we'll talk about. So what are repairs versus improvements? So we need to understand what the difference is. So if you think of it, repairs, they're deductible in real time. So think of things that fixes something that's really broken and kind of restores it to its original condition. Doesn't really add value or extend its useful life. So a great example is fixing a broken faucet, or somebody puts a hole in the wall, you repair the hole in the wall. It's not really adding value, it's repairing what happened and putting it back to its original condition. Not really going to change much, if you're fixing a broken faucet or in those cases. Versus improvements are really based off betterment. So think of it that way. So what you do with improvements is they're not deductible in real time. You take that amount and you capitalize it, which means you take that entire amount, pull it in, and you depreciate over time. So capitalizing means you're just going to go ahead and cover it all and divide it over X period of time, and you're going to get a write-off every single year for that amount. Generally, improvements are for a betterment, adapting for a new use, or restoration. So kind of talking through those three areas. So think about betterment. Does it fix a material defect? Does it enhance the property beyond, its original conditions? Is it increasing the strength, efficiency, of capacity of that? Adapting the property to a new or different use. Are you renovating the back porch and you're creating an entire new like sunroom for guests? That's adapting what you're using the property for. And then restoration, think of this is one of the biggest pieces I love to talk about. Is a lot of times if you're doing a reno, like a full reno, that's where this falls under. Replace a major component or rebuild the property to be like new, or basically return property after deterioration to where it would need be. This does add value. It extends the useful life and increases the capacity or the use of the property. So really good examples, you replace the entire roof of the house, it need to be replaced, or you have an HVAC that needs to be completely repaired, or you decided, you know what, we're going to add a hot tub, so we need a fence and we need a deck. So those are kind of the pieces that split out what a repair versus an improvement are. And then I wanted to talk specifically about the safe harbor rules, just because I know that under the IRS standard, this kind of helps point to what an expense is and how that works specifically. Just because a lot of times, you'll see these way often and way more, and it helps kind of understand a little bit more to a repair versus an improvement. So de minimis safe harbor rule basically says under the IRS, items that are under $2,500 or per invoice, they're all deductible. You fully expense it. So you bought a couch for $1,100. Cool. You bought a $1,800 fridge. Cool. You're able to write that off. No need to capitalize and expense it. You can expense those completely amount. And you'll generally see this a lot of times, like if you're setting up a new home. So you have to buy furniture, you buy side tables, you buy small appliances, a microwave, a TV. You're able to write all of those off in the first year. So that's why I know a lot of times people don't understand that necessarily you don't have to, tie those specifically to depreciating it. You're able to write them off. And the reason why is it's because and they fall under that de minimis safe harbor rule. And so another piece would be routine maintenance safe harbor, which these are deductible if maintenance is expected to be performed more than once. It is used during the property's useful life, and it doesn't really improve or restore the property. So think of this, like for us personally, we own and we manage. We have a HVAC company we use, and every spring and fall we have them service them. We spend $150 and they do it twice a year. That's routine maintenance. It's not something that they need to go in and, hey, there's a structural issue or XYZ. They're going in and just not doing a major reno or a major change. They're just going in and actually trying to say, hey, we're going to go ahead and maintain these and make sure that it is keeping its useful life up to date, but it's not necessarily making it go larger than it typically would be. So other times we've heard a lot of like carpet cleaning is a really big one. Maybe power washing your home or power washing sidewalks. Those are all like general maintenance, and so you'll usually see those as written off as well. And so that's kind of what the difference is there for those pieces. All right, talking about everyone's favorite topic is depreciation because it's very, very, very in depth and can be confusing. So, what is depreciation? It's the allocation of the cost of a long term item or property and just deducting the cost over a period of time. That's when I was saying capitalizing. You're just allocating and taking the cost of that item and you're just splitting it over time. So, when depreciation, there's two pieces of depreciation, which is called either book depreciation, and I'm not going to go super in depth. This is very accounting based, so I just want to kind of explain why there's two and kind of talk what that does for you. So there's book depreciation, which basically just says it's built off the concept of estimating useful life and economic reality. You'll see this a lot for financial reporting. So big companies, they're going to say, I'm depreciating, like Apple, let's say they're a giant company, they're depreciating some of their assets. They're going to say, what is the economic value of that asset? Where tax depreciation is where we're going to focus today. And that's really determining the useful life off of the system called Makers. It's just modified accelerated cost recovery system. You'll never really need to know that. If you just know Makers, that's the system that's used, the IRS built out. And so it just kind of tells you exactly, cut and dry, these types of items fall under this year, and this is how you depreciate them. So again, over those cost amounts that we talked about, generally you would see 5 years are going to be appliances, furniture, carpeting, electronics. Those are kind of general. There is a 7 year. I didn't really note it because it's certain office equipment, but we've seen a lot more that some of the office equipment's not as common as it used to be. So there's kind of been a lot of changes from the maker side. So really 5 and 15 are the big ones. But the 15 are going to be like land improvements. So think like we talked about fences, landscaping, driveways, outdoor lighting, not necessarily part of the building in the structural piece. 27.5 years is a residential property. So when we talk about residential property, do you own your home? Are you short-term renting it? That's what that falls under. So residential property, like I said, it's 27.5 years depreciation, and it's considered to be the parts of the actual building. So think of the things of like the roof, the whole HVAC system, the plumbing system, the electrical system, the load bearing walls, structural flooring, foundation, installation. All of that are specifically tied to the building, and they specifically make in betterment of the actual the home itself. It really kind of think of it this way is like, is it permanently affixed to the property? Is it part of the finished structure? Is it considered part of the building shell? Overall, is it structural component of the building and it's needed? So I always like to bring this example up when I talk to people because it gets a little confusing, but carpet. So generally carpet's considered a 5 year deduction, as it's tangible and it can be removed and replaced without really affecting the building, whereas replacing the entire flooring. So let's say you come into a house, say, I'm going to do all new hardwood floor. You're really affixating those to the floor. Your goal is to not really change it out. It's going to make the house better. It's going to really be part of the structural foundation of the home. That's going to be considered residential property. And that's why it's really, really important. And you probably have heard this so many times is cost segregation. And that's what I love to bring up and talk about too, is because cost seg is actually one of the major benefits of doing depreciation. And so moving forward, cost segregation is not everything at the property is considered to fall under the same category. Of course, we just, clearly saw that. If you think about that, the carpet is 5 years, where the hardwood floor would be the 27 and a half. And so a cost seg allocates each item to respective category without the appropriate cost, or sorry, with the appropriate cost or amount. So you're actually depreciating correctly. Land is not deductible and it must be broken out of property regardless. You cannot depreciate land. So if you're going to go buy a property, it's 400,000, land is going to be part of that property. You pay property taxes on it. That's deductible, but that's the point, is that you are not able to actually write off land. And so cost seg is actually really, really helpful and really good to determine what the actual land value is too, because that kind of breaks it out for you. So you don't have to just kind of use this. A lot of people use the 70-30, 75-25, or 80-20 rule, but doing a cost seg gives you the exact number, and so you're doing it accurately. So the things that I do want to talk about too, because a lot of times these are missed, is when you purchase a home. So we are in the process personally of purchasing another short-term rental, and all of these that we have to pay for or get paid for are actually not, you don't think about in the purchase price, because you're saying, hey, I'm going to buy this for 300,000. oh, but you pay for all these other things. So the purchase price is one, legal fees, title fees, recording fees, survey fees, transfer taxes, owner title insurance, appraisal for the acquisition, and inspection fees. All of these actually get capitalized as part of the purchase price and they get deducted over that 27.5 year mark, which is super nice. But they're usually missed because you don't know that. The other pieces that are not capitalized but are deductible, amortized, mortgage insurance, like we talked about, that's the deductible expense. Property tax, insurance that you prepaid. A lot of people miss that, and so that's something you definitely want to see. Is when you go on your closing statement, you'll see that you've prepaid or the seller paid or whatnot, a specific amount for like utilities. So there may be trash, there may be water, there may be sewer. Those are actually part of prepays that actually are deductible. Loan origination points, those are the ones that are amortized, and then escrow deposits, basically saying I'm paying my property insurance early. That's, you're not going to necessarily, write that off. It's just going to go in and not be tied to the actual capitalized price. So and that's how all that works, specifically with the cost seg. But with cost seg, that leads us to depreciation for bonus depreciation. I know if a lot of you were here last week, we talked or a few weeks ago, we talked, and there was a lot of different conversations about, cost seg and whatnot. But I wanted to highlight specifically a little bit more on, bonus depreciation, so you could have it written out and see, so you know what's going on with all of that and how that's working right now. So what is bonus depreciation? It basically allows you to accelerate depreciation for the 5, 7, and 15-year assets by deducting a large portion in the first year. Instead of a general depreciation over the course of the life, you're able to really just write it. It's called bonus. You get to write most of it off. And that's super, super nice whenever you're having to do that anyway, because you're going to want to take the expenses really as soon as possible, especially if you're going to be using the short-term rental tax loophole, which we'll be talking about shortly, against your W-2 income. Take that off in the first year because that's when you're going to have the most expenses. You're going to be, getting the property ready. You're going to be doing all this stuff. You want to make sure that you're taking the biggest benefits you can. So it does not apply to the main building structure. So anything that's 27.5 years, it does not. It does not. So it's very, very difficult to say. So I always make sure I note that. For 2025, which of the big beautiful bill, we talked about this last time, is that assets that were acquired and placed in service after January 19th of 2025, you can deduct 100% of the bonus depreciation. It was actually going down to 40%, and then the new bill that was signed into law last year was actually 100%. And then for 26, it's still going to be 100%. So just know that there is going to be 100% bonus depreciation. So you get to write it all off. And there is no dollar cap on bonus depreciation. It's just capped at specifically what is the IRS standard of, like I said, it was 40%. Now it's 100. So that's the cap. It's not capped at 100. So that's great. All right. So we're going to talk about the short-term rental passive versus active income. With that, I know a lot of you have asked about it. We're going to talk about it. The short-term rental tax loophole. It can be a little bit tricky, but we always want to make sure that we kind of talk about it because it kind of gets lost sometimes and a little bit confusing. Whenever short-term rentals first came out, basically, unless you qualified as a real estate professional, which meant that you did real estate majority of your time, that you didn't really get to write off it, and it was all considered passive income. And I say this because short-term rental income is rental income. Rental income is considered passive income, and passive income isn't considered earned or ordinary income. And so because of that, you can't write off the losses against ordinary income. You're not able to do that. So passive income can't be used to offset that ordinary income. It can only offset other passive income. So if you have a loss on one rental property and an income on another, you can only net those two together. But the goal here is, could you use the short-term rental tax loophole because you're actually doing work? Short-term rentals, I would love to say personally that I would get done working and that I just had someone rent my house and it was done and we were good to go. It is a lot of work, and I'm sure a lot of you do know that. So I personally consider it active income, and the reason why is you are doing a lot of work, and it is active. So that rental activity can actually be treated as ordinary income of one of two things. One is the average period for the customer using it, generally 7 days or less. When I say 7 days or less, that's the short-term rental concept. It does not mean, and I want to say this, it's the average is the average. It's 7 days is the average. It's not that someone can book it for 3 weeks and say, okay, well, no, it's no longer a short-term rental. It doesn't count. It's the average throughout the year. Or the average period is 30 days or less and substantial services are provided. That is very, very, very specific because it's more or less saying that like that's almost like a bed and breakfast kind of situation that you're consistently cleaning daily and frequently, even though someone's there for 30 days. Their linens are getting changed. You have site on staff, like on-site staff, you have meals you're providing. That's a little bit different. And so most people actually do fall under the first one where it's the general use of 7 days or less. Then on top of that, material participation is requirement is part of that, and so that's something that's really necessary, and that's what we'll go into depth in a second. I do also mention that we talked about, which we'll talk about a little bit more in depth in my next seminar and webinar, is a little bit more about property management income and how that's split and how that works, because that generally falls under Schedule C, which is just ordinary business income. It's not passive income. While you're managing, because you're doing something that's not necessarily renting out, you're doing other pieces as part of it. So that's why it's generally tied to a Schedule C or business income and not Schedule E. So, material participation. This is the tricky part. There's actually 7, but realistically, the top 3 are the ones that usually people hit, and there's a reason why. So there's 3 main tests to see if you do. So 1, do you perform work for more than 500 plus hours in a given year on it? Actually, if you think about that, that's average as more than 10 hours per week doing work, and most self-managers are going to hit that. That's very common, and it's easy to do it that way. The second one is, are you performing more work than 100 hours in a given year, but no other person's doing more work than you? So let's say you did 120 hours in one year. So you didn't hit the 500 mark, but you had a cleaner who did 90, and then you have a handyman that did 40 for you. You go ahead and qualify because you did that. So that's generally if there was limited work for you to start off, or it was a slow year and you didn't really have a lot of bookings or something, or you just started your you don't qualify, and so that those are kind of the pieces that you're able to do as well. And then you perform substantially all activities and no one else performs other for meaningful services. So this is really meant saying I don't actually hit 100 hours a year, but I literally do everything. I'm the one who's cleaning, I'm the one who's doing maintenance, I'm the one who's going and doing the messaging calendar, I'm working on all of that. But I didn't qualify because I didn't hit the hour mark. So those are kind of the 3 main tests that you can qualify for. I always say the nice thing is that it's reevaluated every year. So if one year let's say you hire a property manager for a year and say, oh, I didn't hit it this year, but you know what? I actually want to take my property back. I want to do it again myself. Then you're able to actually, do it for the following year. So the nice thing as well is that if you're married and filing jointly, spousal participation qualifies. Does not matter the amount. So if you and your spouse are doing this together and one of you does 95 hours and the other one does 500 hours, or 450 hours, so then you hit the 500 mark, then technically it counts to hit that. You guys do qualify since you're filing jointly. Of course, you're going to be on the same return. The best practice: track what you're doing, when you're doing it, and how long you're doing it. It is a lot easier for a self-manager to basically be like, you can literally show if you ever had an audit, look at all of the things I'm doing consistently. It's a little bit more tricky if you are, and this really, when I say it falls off the W-2 piece, and that's why, is because that's the scrutiny is, are you writing it off against your W-2? Well, can we make sure you're actually qualifying? And so the material participation piece is super, super important. So when in doubt, just track what you're doing. Just say when you did it and how long. And it can be in a spreadsheet. It can be honestly on a Word doc. And I know there's a lot of people I've heard that use certain software that actually will do it. You click your timer and then you just type in what you did on it. And so it will track all of that for you as well there. And then we'll talk about now that you said, hey, I actually got the short-term rental loss. I qualify, I materially participated, awesome. How does it work? So when you qualify, so the loss in the short-term rental can actually offset your ordinary taxable income. So it's limit to $0 taxable income, which means that if you had a W-2 that was $100,000, you had $150,000 loss, you can't say that IRS owes you taxes on negative 50,000. What that means is that you have a net operating loss, or NOL, and you're able to carry that forward. So just numbers, just so you know. If you're single filing, that means you can have a 305K NOL. So that means if you had 500,000 in loss, but you only had 100,000, you're only able to carry up 305 forward for that loss. And then married filing jointly, it just doubles. It's 610 basically. A lot of times, most people don't. I wouldn't say they don't have the hit of the NOL carry forward, but they'll usually be able to offset most or all of their taxable income, which is super nice. So what if you don't qualify? It cannot offset that taxable ordinary income, but it does offset any of the other passive income you had. So that's something that's important. So if you have other passive income that I mentioned, that's important to say. And then the remaining loss is carried forward indefinitely. You're able to use it going forward, and then you'll always have that forever going forward. So that's just kind of how the application of all of that works. So now, I know there's a lot of questions. So with these, and so I just wanted to kind of high level talk about best practices and the common mistakes, as well as a little bit of audit pieces, because I know we hear that quite a few times about auditing, and so I just want to kind of give you the data of what that means. So moving forward, let's talk about documentation and audit defense. I say audit defense because that's basically saying you have set yourself up in the case that you did have an audit, that you are going to have to defend yourself. That's what the point of an audit is they're checking. I used to be an auditor. It's not a tax auditor, but I was an internal auditor, and that's the goal, is you're checking that are the processes being followed, or the things accurate. So for accounting and protection purposes, maintaining documentation is honestly super crucial. So the short-term rental loophole qualification, like we talked about, some of those things are average stay calculation, time logs of what you're doing, what is your role, how are you working in there. Average stay is kind of, if you use Hospitable, of course, like it's super nice. You can just pull up all of the data and say how many nights were booked and how many were not, and then you can see how often they were and what the average stay was for all of those. So that's easy to kind of track. Operational documentation would be like bookkeeping, reporting, communication history, cleaner and vendor contracts if you're using those, and then if you have any contractors, you have income and expense receipts. When in doubt, just take a picture of your receipt, honestly, and save it. The nice thing is with the OTAs, you have all that data built into them, so you can pull that, but making sure you have some receipts and documentation is important. Depreciation, a lot of things, closing statements, basis allocation support, there's cost seg reports that they'll give you if you do those, that you're basically showing, hey, I have all this documentation, it's provided for me. And then you're able to kind of keep those aligned. I always say the burden of proof is on the taxpayer. And what does that mean? It literally means that the IRS, their job is not to prove that you're wrong. You have to prove you're right to them. And that's just what that means, is if you're going to say, I get this deduction, you need to show them why. They're not going to be like, okay, that's wrong. That's why taxes are so tricky, is that there's no right answer. It's, you need to show us why you're right and why you chose to do it this way, and then your basis behind it. So it's always going to be the proof burden of the taxpayer. And then best practices for accounting. So I just kind of high level set up what you would be doing if you're doing your accounting day to day, what you should be doing if you're doing it weekly or whatnot. So business creation, develop a business. I'm, like I said, I'm not a lawyer. I'm just telling you what are best practices and what to do, not telling you what specifically to set up. But setting up an LLC or a partnership gives you that liability. So like all of my that we personally own, that they're all set up in an LLC, or like we had a partnership with a few friends of ours. We created a 1065, so we had a partnership LLC there. Separation's a really big one. So making sure you have a dedicated bank account or dedicated credit card limits, or really, when I say that, it's limiting personal transactions inside of those. Those can get tricky because you may accidentally, allocate things that aren't specific to an actual booking or an actual, like, the business itself. So trying to have some type of separation and using different accounts is super important. Bookkeeping, so recording the gross income, like I said, categorizing your expenses properly, tracking your capital purchases, so those assets we talked about, so then they can be capitalized, depreciated the correct way, and know what they are. Again, like I said, having the receipts for those is super simple because you have the data right there. And then reconciliation. So whenever you get a bank transaction come in, make sure you're matching it and reconciling it to the actual booking, making sure, one, you did receive all of the income you should have, and two, that it's accurate. Reviewing your P&L, just checking out to say, am I making money? Am I losing money? Is this accurate? And then we talked about the same thing. Keep your receipts and documentation well organized. Like I said, when in doubt, the more detail is always better. there's nothing wrong with keeping too much, I would say. Like there's literally nothing wrong with that. It just means that if you have an accountant or CPA that has to deal with it, that they would have a lot more data to go through sometimes. But just having them, like for example, like our receipts, I scan all of our receipts into the computer and then I allocate them in QuickBooks. And then what I'll do is I throw them in a receipt box. And so if I ever got audited, they have a receipt box and I have all the scans. So I have everything that they would need. I know sometimes there was questions in the past about, well, what if I just use my bank statements? Is that okay? Yes, again, it goes to the little bit of point of saying that there may be more scrutiny, and so again, the burden's on you. What does the auditor feel is reasonable? If you have seven, Costco receipts that you just have statements that say I went to Costco $300 and there's not really detail. That's a little bit tricky because then it's like that kind of walks that fine line. So, like I said, having more detail is always better, but having bank statements or credit card statements is good too. Like I said, more detail, the better. And not saying that if you just, oh, I lost this one receipt, I can't write it off. That's not necessarily what I'm saying. But the more that you can keep and more you save, it's much better for you. All right. And then common mistakes. I just kind of listed the top that we have seen personally in my experience as a manager, and as a CPA working in short-term rental, and kind of just talk through them and how that works and all of those pieces. So very main one, allocating payouts as income rather than gross income reporting. We talked about that. And I know Amanda mentioned it last week too, is that actually could be sometimes a trigger for audits. And that's what it is that on your 1099K, they're reporting your gross income. And then you go ahead and enter that 1099K and say, okay, cool, that's right. And then the income doesn't actually match. You're just saying, oh, well, I reported everything as payout, so it's net. You're like, oh, well, you're missing, especially now with the host only fee, you're missing quite a bit because that service fee went from 3% to 15.5%. And on some bookings we've gotten paid for, it's a lot. And so when you're underreporting by thousands and thousands of dollars, that's a bigger trigger that potentially could happen. That's an IRS mismatch whenever that, because basically the system has all that data, they know. So whenever it ties to your taxpayer ID and it doesn't come in accurately, it's like okay, that's a discrepancy. Expensing an improvement rather than appreciating, talked about that. And it's common with that may trigger an audit. It's riskier because it's really just the amount. So if you're going to go ahead and expense out a $30,000 roof improvement, that could be, I don't know if roofs are 30,000. I think last time we had it done, it was like 20, personally, but basically that's a high trigger. That's a major expense for one specific thing. Okay, it does sometimes trigger that. So having that and knowing the difference there. Not tracking material participation, we've seen a few times. And like I said, it's really simple just to say, hey, I own this business, this is what I do, I spent this much time updating pricing, I updated the guest portal, I did this, like giving those datas, just having that available is helpful. Let's see, mixing personal and business funds, like we talked about, just trying to separate those as much as possible. Misclassifying repairs versus improvements, which we talked about. And then not tracking assets. So basically, when I say not tracking assets, it's almost kind of the same kind of concept that you're maybe just be expensing some things instead of actually saying, okay, this is an asset that needs to be depreciated, or I bought a MacBook that did cost, like some MacBooks like do cost $3,000. That is not able to be expensed. You have to either bonus depreciate it, which you can now, or you would be able to just write it off over the course of the 5 years. So just keeping track of them is helpful. Skipping and missing depreciation is a big one. I didn't talk much about it from that perspective, only because if you're, I know a lot of concern is depreciation, and not like I don't want to have to take it all, and then in the future I'm gonna have to expense, like I'll have a giant gain and I'll have to pay tax on that gain, and so some people just try not to take it. Well, there is depreciation recapture, which basically, and just so you know, and there's a lot more detail, you can look into it, just high level, that the IRS assumes that you're going to take depreciation. So regardless, they force you to pay on a gain a certain percentage, as a depreciation recapture percentage, even if you don't take depreciation. So definitely look into those. And if you have a CPA or an accountant, they can kind of help you do that. And a cost tag is a really great way because they can kind of talk you through why or what the reasoning is behind that. And then finally, not consulting an accountant or CPA, which is, I'm glad that all of you are here today. If you haven't, worked on one or had one at all, this is really great to just just even consulting somebody else and feeling like, okay, am I doing what I'm doing correct? It kind of gives you peace of mind to know that, okay, I'm in a good spot. I have some backup, I have some data there, and it kind of helps give you that protection because again, they're licensed, like I'm licensed, and it gives them, they have the expertise, they have that background, that experience. And so I think it's something that you could definitely just always suggest doing. Again, like I said, I'm hospitable. I work for Hospitables Accounting. So everything I'm saying, I'm just, personal experience. It's not the end all be all. Do not take everything I say for word and follow what I say. Definitely consult your CPA because that is more important to make sure that you are aligned with what you need to do for your business and making sure that you're set up for success. And I think with that, I think that leads to Q&A. And I know I had issues with this last time, was actually getting rid of the background, but we'll try and see if it works. Okay, oh, perfect. Okay. Are the material participation hours you mentioned last session only applicable for deducting W-2 work hours during a lost year? So it's on ordinary income. So anything that goes under, so W-2 is most general, you'll see that, but it's anything that's considered ordinary or earned income. So if you do end up having earned income and you're able to pull off of that, it's basically just turning passive income into a loss. Passive income into an active income, and then it's able to counteract those kind of from that perspective, because you can think of the same idea with passive income and passive losses. You can carry it forward. Same idea. You can carry forward active losses as well. So there are people that do have that as well. So it allows you to specifically do that on your end. How do you recommend recording the commissions on the P&L? I'm assuming, I wasn't in the chat, so I'm assuming that this may have to do with host service fees. If not, I'm sure that someone will pull out a question there. But I generally say that if you aren't using automatic, what you're able to do is pulling it up on, so we have like an auto integration with QuickBooks you can do, and it automatically allocates the gross income. If you're doing it manually by yourself and you pull it in, you can pull the reservation data. So we have all that data built into your metrics and all of that. You can say, oh, here's the accommodations, break out the fees, and then you can also record the host service fee. So if you're using a specific software, for example, QuickBooks, like I enter it as an expense and it will pull it in a line item and make it negative, and so it does it automatically. So that's, I generally do it as I used to do it. I use the QuickBooks integration now, but I always report, the accommodation separately, any of the fees separately, and then because you have reported the accommodation, you can actually add that service fee in there. So you're reporting everything differently, and then it will actually net out to that same number. So that's what I typically have done. Okay, let's see. I did not get a 1099 from Airbnb. I was wondering it was because a consultant located in Canada set me up as a Canadian account. I am in the US. I'm thinking I've gotten them in the past, just don't recall where I access. So I'm not 100% sure from their reporting standards in the actual like Canadian side of things or how it is set up. But the 1099K standards and reporting actually changed again with the big beautiful bill that was implemented in July, but yeah. What it changed to was that a payment processor no longer has to do that lower threshold where it was going down to $600. The actual threshold went right back up to 20,000, and you have to have 200 transactions. So a lot of people hit the 20,000. A lot of people didn't hit the 200 transaction mark. So that's general why a lot of people didn't see getting to 99Ks this year, unless you're in a specific jurisdiction that will determine, certain states do require that you do have a 1099. So Illinois was one. And that you have a lower threshold. New Jersey was another one, and those lower thresholds just require that you did get a 1099K regardless. So that's a likely reason. I'm not 100% sure if that's the exact, so I would check on that to be sure. But generally, we saw a major decrease in 1099s this year because of that. Even personally, internally, we did too. So. I thought short-term rental residential property was now 39 years. I'm not, what my makers was 27 and a half. I'm not going to lie and say that changed, but it definitely could have. from all the data I was looking at, it was still 27 and a half years. But if it did change, I will take a look. And I'm assuming it would have changed in the bill as well. The makers usually doesn't change as much. So I will definitely take a look and see if that's the case. But when I was looking at, so it was 27 and a half years whenever I was looking at everything recently as well. Okay. What about depreciation for new windows and mini splits and a new electrical box? Are all these 5 years or are they 27? So I know for a fact, in my experience, windows usually generally align to the 27 as the house. But what I do say is, again, everything is going to be specific on a cost seg. So if you did a cost seg, which some people say they may be a little bit expensive, but the benefit much outweighs. So if you go through and something costs you, it costs 4,000, let's say, to do a cost seg, but you were able to write off an additional 25, 30, $40,000 in 1 year as bonus depreciation, you kind of just saved a lot more in tax there. So definitely say, check it out and see if that's something, but it's going to be dependent on every single situation, because certain times, like I was reading about, just from my experience, that sometimes vinyl flooring is considered the 5 year, but sometimes it's actually not. It's considered the 27. It just depends on what type of flooring it is, how often it is. That's why carpet generally falls under the 5. So again, also, like I said, definitely check with your accountant or your CPA and validate that to be 100% sure of those cases. So majority of Airbnb stays are less than 30 days, which is actually commercial appreciation, not residential. So the slide is okay. Majority Airbnb stays are less than 30, which is actually commercial, not residential. Residential, though, it depends if it's considered residential or not. But that's generally, I just pulled the makers numbers, so I understand the confusion there, and we can provide a little bit more data too, specifically for commercial. And I completely disregarded that, and I apologize on that piece, because yes, there should have been a slide on commercial, which commercial does has a higher depreciation rate. So I do apologize. Thank you for pointing that out, and we can provide more data on the 39 year as well too, in commercial, because that is where I think I was confused, missing the point there too. So, do you have options to choose one or the other? Meaning, if I can use mini splits for 27, actually want to do it over 5 years to keep more cash in my pocket, is that allowed? Use many splits. So I know that bonus depreciation, you have to take it all. It has to be in the first year. It was placed in service. So bonus depreciation has to be taken at that rate. And then the rest would be depreciation over time. But since it's 100%, that's the reason why now. So that's specifically the reason tied to that, if that makes sense. But yeah, so bonus depreciation would have to be all at, like, all or none at the same time. And that's the reason why. Excuse me, I'm sick, so I apologize if my throat is a little sore. If you meet the material participation requirements, do you report the activity on Schedule C or still on Schedule E, just active on Schedule E? So it's still going to be on Schedule E. So Schedule E is rental activity, and that's always going to be on Schedule E. Schedule C, like I said, it's ordinary business income. Most property managers do actually put it on Schedule C because that's what they are, but they're not actually doing it's no longer passive at that point. It's considered ordinary. So Schedule C is going to be more for ordinary income, and Schedule E is for rental. So even if you're passive, it still would go on there. And that would kind of align with that. Okay, sorry, I'm trying to run through because I know we only have a few. So I'm trying to pull up some more questions that, okay. Should furniture or appliance purchases go under house supplies and transactions? So again, that kind of falls under, is it an expense? Excuse me, is it an expense that is deductible now, or is it needed to be capitalized and expense over a period of time, such as furniture over the 5 year period? So again, follow under that $2,500 mark of the safe harbor de minimis allocation by the IRS. If it does fall under, you can put it under house supplies. You can call it really whatever you want. There usually is, when you're filing your tax return on Schedule E, there's going to be like an other category where you just type in whatever you specifically want. So if you break it out a little bit more, but just making sure that you would want to tie that specifically to what it actually aligns. So I use personally house supplies. That's what I've personally done in the past if it's a expense that I'm able to write off for furniture or appliance. But again, it's totally up to you, as long as you're making sure that you're allocating correctly and keeping track of that. Can you material participation rules to real estate professional benefits. So this is a little bit more tied to the actual, I talked about real estate professional. It They kind of both align. Real estate professional, it's a lot more scrutiny to be able to fall under real estate professional as it ties specifically to real estate. So it's easier to fall under material participation specifically with the rule of the short-term rental, because material participation, I believe, under it was 750, but that was 5 or so years ago. I don't know if it's still the same, so I don't quote me on that. But for a real estate professional, but it is a little bit easier to fall under the short-term rental loophole because of that specifically. The 100-hour rule, where you need to have more than time another person, does the count per cleaner. Example, I have a cleaning company, but the same person doesn't always clean. So is the rule per person and not company? Hope that got what you're saying. Yes. So it's going to be more than any other person. So basically, as long as, let's say you have, it basically, when you're looking at cleaning, I'm just going to kind of align that a little bit, that as long as you're not paying the cleaning company, I'm assuming, don't quote me again, I would consult a CPA, but paying each person separately and saying that you're giving them a 1099, you're paying different cleaners, more than any other person, it does kind of align that a little bit more. But again, in those certain situations, I would definitely consult a CPA or an accountant to make sure that you do fall under the tax loophole accurately and you're not, reporting it and for that reason. So that's what I would just say, is definitely check. It kind of aligns a little bit more, but definitely want to check on that from your perspective. Does the occupancy tax get pulled into automatically to QuickBooks even if Airbnb has remitted? So no. So we don't pull the occupancy tax into QuickBooks is if it's remitted on your behalf, because at that point it's not going to be included as income to you. So the only time it's ever pulled into actual income to you and then you would expense it out is when it's specifically sent to you via pass-through tax, because that's how it's reported to the IRS. So the IRS, of course, is reporting it as income. It'll be passed through to you, and then you'll pay it and expense it at that point. If it is remitted on your behalf, they are the ones managing that, so they're acting as the agent. They're doing it, so there's no need to have that be an expense to you on your end. So Airbnb provides monthly statements for hosts. It lists gross revenue, their service fee and adjustments, which is any refunds, cancellation, or anything else that was withheld. Is this the adjustment expense? Which is the refunds, cancellation, or anything else that was withheld. Oh, okay. I think I understand with what you're saying. So if it's specifically about adjustments on, so example, if someone books the property, you refund them after the payment's been processed, you get that taken out of a future payout. My assumption is that that's what you're saying, is that that would be an adjustment, that would be an expense, because you're reporting both of those as gross income. That number, because it's cash basis, like we talked about, was actually paid out and processed to you at that point, and then it was just taken out of a different booking, so it wouldn't be the same idea as the host service fee. They're not going to ask you to pay them back. They're just like, oh, you already have it, we'll just take it out and we'll refund that guest. That's why that's going to be an expense to you. So generally, the rule of thumb is if it's refunded before it's paid out to you, then it's not going to be income to you. Don't have to expense it. If it's refunded after it's been paid out to you, then yes, you're going to go ahead and expense it after the fact, because then that's how you'll be recording gross income. Let's see. I know we're almost out of time, so I'll answer 2 or 3 more. When you say you separate the accommodations separate from the services within QuickBooks, do you mean you do a transaction split? Yes, that's exactly what I mean. So I do a split line transaction. So what I used to do is, like, the bank payout would come into QuickBooks. I would literally split that and say split transaction. And then if you tie it to an expense line, you would just make it negative on the end, and that would get you to match the end payout, because you'll be at like 1,000, 1,100, and then it would be like your payout was like 970 or whatever after your host service fee. You just make that line item for that expense negative. So that would be specific for that. If my commercial short-term rental has losses after considering depreciation, can I use accelerated depreciation for improvement section 179? I did look a little bit into this yesterday because I know section 179 changed. Bonus depreciation, yes. So you can still, there's still the limitations on when you can use it. So I know typically you use bonus depreciation first, and then other people will use section 179. A lot of times, because of the alignment of how much users are usually depreciating, a lot of time bonus depreciation does cover most of it. So it's, now that it went back to 100%, that did cover a lot. So you'll see that more often than not. And then I saw before. Okay, can you just capitalize furniture, decor, etc. before the property goes into operation? Renovating after purchase, but before operational. So again, definitely make sure you align this with an accountant and check to be 100% sure that aligns that's okay to do that. Generally, when they say placed in service is like when it actually was being used. So if it was purchased, so let's say I purchased, I don't know, a couch and it comes in 6 months. Placing it in service means I put it in the home in 6 months. So that's why I can't just say I bought a couch, I paid for it now, can I depreciate it? And I don't get it till next year and it's not placed in service. Placed in service stage is super important. So make sure that aligns. And if you have questions on that, definitely check it out and see. And the IRS does provide a little bit more guidance on what placed in service is, and how that works. So you're not necessarily doing that holistically and may be doing it incorrectly. And then Rachel said, do you have staff at hospital that helps with questions and setting up the QuickBooks integration? So yes. So I do office hours specifically for QuickBooks. We do have an onboarding team that has been helping with that. And then if filters questions, they come to me. If need be. We are actually building out a new group of questions that are specific for our users to be able to help implement the QuickBooks without having to go through the help articles, having to, do an onboarding call. Basically, they're going to be videos that kind of walk you through every single step of how the QuickBooks integration works and how it's going to align for you and how the process works. And then you're able to actually submit it and send it that way. So and that's how we're going to be hopefully releasing those in the next coming weeks. And then you'll be able to do hands-on and actually do one by one watching the videos. I know a lot of people are more learners that way. And so that's kind of how they used to do is visual learning and doing it hands-on. So hopefully you'll see those coming in the next coming weeks, and then you're able to kind of get all of that aligned. Okay, and I think there's a few more slides that I just need to get up. Hopefully, well, there we go. Okay, cool. So I know that we usually talk about this in the community, and so Petra did go ahead and post this, that if we want to have more conversations, we'll definitely give some more information and make sure that we have more on commercial property. And I do apologize that I only talked about residential, and so I apologize for that. What's considered commercial and residential, and kind of get all of that sent out to you. So you have a little bit more data on that. Again, like I said, it's good to always consult a CPA or accountant if you have questions about depreciation, because that is a very, very tricky area, and they can help provide the best information for you. And so Petra will be posting a few extra things there. And then we'll also, like I said, I'll make sure we get some more information about commercial depreciation in case that aligns for some people that are not and need that. So again, in 2 weeks' time, we'll talk about everything that helps to be staying compliant with hospitable, and talk a little bit more, like I said, about property management, what the QuickBooks integration does, what we offer as reports, metrics, and kind of all of those pieces. But for now, that's what I will leave you with. And I hope you guys all had a lot of great insight and a lot of great questions. So I really appreciate that. And hopefully this helped you at least get a little bit more compliant, considering tax time is right now. And I know that business returns are due in a few weeks, and then final individual returns are due in April. So more to come. And then I hope everyone has a great day. Thanks, guys.